Well, I mean, sir, we already had several segments of the yield curve already inverting before, today's move in the 3-month 10-year relationship to like -1 basis point. Today's move doesn't affect, my forecast on what's going to happen in the next 12 months any more than yesterday's rally in the stock market did. But several segments of the curve were already inverting, and actually the leading indicators for what we saw today were coming into play several months ago. So am I surprised? The answer is no, I'm not surprised, and there's nothing happening today that alters my view. The bigger picture story actually for the stock market is that the S&P 500 is actually lower today than it was in January of last year. That's really the big story. The big story is that the peak in the S&P 500, notwithstanding the flashy rally this year, the peak is in. And the peak in the S&P 500 has led the peak in the economy in the past 100% of the time. So that's all we really have to know from an economic standpoint looking ahead.
David, a lot of the focus today obviously is on the global picture, the international data, and we know that's been bad, and I guess it's showed that it could be worse still today. Do people miss the point about how much that's affecting the US economy, or is the US economy looking fairly downbeat for its own reasons?
Well, it's a combination. The U.S. economy is very much a domestic demand economy, but there is no economy in the world that actually lives in total isolation from its neighbors. But the bottom line, and I'm going to sound like a broken record because I've been saying this for so long now, that the Fed has raised interest rates 9 times. No other central bank in the world has raised interest rates 9 times. And there are inherent and long and variable lags between what the Fed does and then the impact it has on the economy 12 to 18 months down the road. There's still work to do. I know that everybody got excited over the Fed pivot, but the reality is that the lagged impact of what the Fed has already done, and it was a very aggressive tightening cycle that was not matched anywhere else in the world, is going to have a lingering impact into the economy over the next 12 months. If the Fed starts to cut interest rates and stimulate policy, which I think that it will do, that will have a beneficial impact 12 to 18 months down the road. People, because in today's world of social media and all the noise that we get, they can't seem to see the forest past the trees. The lagged impact of what the Fed is doing and the impact that's had on the credit-sensitive sectors of the economy is, I think, the overriding impact of what's happened to growth so far in the past few quarters and looking forward, irrespective of whether we get a trade deal with China or not.